Well, thank you all for taking the time to join us today. You're with Dean, Ryan and Gabriel for our Q3 webinar. Dean, I might get you to pull up the slides and we'll start with the general disclaimer. We'll go through some financial information today. This is of general nature. If you are interested in personal advice, please go and seek that advice from a registered financial advisor. Any tax-related advice, please seek advice from a registered tax agent. Today, you're joined by Dean, the CEO, and our Chief Investment Officer, Ryan. We're going to go through two stages of the presentation. As always, a bit of an update on the fund from Dean. He'll cover off where the fund's been over the last quarter, and as always, take a bit of a deep dive into the secret sauce, and in this instance, giving us a practical outcome from the $20 billion liquidation event. So how did the fund fare through that liquidation event? Ryan will then look at the market ahead, how we're looking for Q4, and do a deep dive into the sector, what he's seeing out there in the market, and then how that's driving the decisions we're making from an investment perspective. As always, if you've got questions along the way, please ask those questions. How do you ask? If you go up to the top of your screen, you should see take control, pop out, chat, then next to that is Q&A. So if you click on the Q&A button, type in your questions in the Q&A area, those questions should queue up and we'll be able to answer those questions at the end of the session. Without any further ado, I'd like to hand over to our Chief Executive Officer, Dean Serroni, to give us an update on the fund. Over to you, Dean.
Thanks very much, Gabe, and thanks to everyone on the call for carving out 30 minutes of your day to join. Straight out of the gate, so I just want to provide a brief overview of our fund. For those who are already invested, just a refresher, and for those that may be considering investing, just how we allocate to the space. So what we do is we focus solely on liquid digital assets. So these are liquid crypto tokens only. So the fund doesn't invest in equities. We don't invest in ETFs, DATs, etc. It's purely spot cryptocurrency. And the team focuses on active management. And what that means is we're constantly looking at the macro landscape and the crypto landscape to make sure that we feel like our portfolio risk setting and our portfolio allocation is set right to essentially capture what we think is where we need to be through the various stages of the market. What we do is we focus primarily on the top 50 assets by market cap. So these are the more established projects and projects that have established teams, revenue, really core fundamentals that allow us to invest in those assets. And we take risk management exceptionally seriously in everything that we do. And so the fund does not take leverage at any point, and we cannot take leverage. So that means we don't go long and we don't do shorting. So this is and we'll talk a little bit more about what this means in crypto and some recent events that are quite noteworthy and why this strategy held up well through that period. In terms of yield, the fund does do something called staking, which is native to cryptocurrency, and it is risk-free in the right custody setting. We earn around 3 to 4% yield on the portfolio per annum, which covers our 2% management fee plus more. And in terms of custody, so this is the way we store assets. We do that via Coinbase custody, which is institutional grade custody and has an insurance overlay on that. So looking into the portfolio a little bit around the asset allocation, this is at the end of September. You can see here on the left, store of value is still the largest segment of our portfolio at just around 45%, which is actually down a little from 50-ish% in our last update. And that is because the layer one segment of our portfolio has been performing a little more strongly over the previous quarter. So layer ones are the core blockchain infrastructure that we invest in. And we believe that right now that is the right place to be in terms of achieving that asymmetric performance. And then we have smaller allocations to subsectors of the asset class. That includes decentralized finance, decentralized physical infrastructure networks, and Web3 projects. And these allocations for us are small allocations, anywhere between 0.5% to maybe 1.5% per allocation. And we're investing in slightly smaller market cap projects that we think through the right periods in the market will have outsized returns. Now, holding that thought around risk management and not taking leverage, just want to roll into a recent event that occurred almost 2 weeks ago. And this was a global event on the back of a Donald Trump tweet around them applying 100% tariffs to China and really escalating the trade situation with China. And what that meant in the crypto markets is on the 10th of October, we saw investors start to go a little bit risk off. And due to the sheer volume, the buildup of leverage in the crypto space, we saw that really start to spiral. And so the reason we saw $20 billion essentially of leverage wiped out of the space and not the same sort of dramatic impacts on broader markets is really to do with the fact that crypto, being slightly less regulated than some of the more mature asset classes, does allow for 100x leverage to be taken on positions. So that sort of unraveling of excessively built up leverage in the space did snowball, and we saw just short of $1 trillion wiped out of the market in terms of leverage in the space of just a few hours. So it was a significant event, and to put that into context, in 2020, with a COVID liquidation event, we lost about 1.2 billion, and FTX in 2022 was around 1.6 billion. So this $20 billion liquidation event is over 10x the size of those previous two major events. It just really does put into context the scale of this particular event that happened recently, but also the size of the crypto space and the maturity and the way it's grown over that period. So that sheer volume of capital that it had built up. But what we did see is a really sharp recovery in a matter of hours. So Bitcoin as a proxy dropped from around all-time highs at 126K down to 102K, then bounced back very quickly back up to a 116K level, and alts, the other assets in the space, were even more dramatic. Some getting belted down, up to 90% down, and then recovering as well. So really, what this did emphasize for us as fund managers is just how important it is to have really robust and diligent risk management, and just re-emphasize the importance of the way we think about things, which is to not hold any leverage positions in the portfolio. So whilst this event, when it occurred, it impacted 1.6 million crypto investors, including a lot of funds which had their capital blown up. We essentially watched the heart rate did increase through this period naturally, but we weren't directly impacted at all. It was just a case of really re-emphasizing the fundamentals and the macro backdrop being strong, and the crypto backdrop being strong, and this event being a short and sharp event that has now is essentially washing over. So moving on and looking into our fund and Q3. So Q3 was a fantastic quarter for both the markets and our funds. We returned positive 14.8% to investors, and that's against a backdrop of Bitcoin, which did positive 5.9 for that same quarter. And so I spoke about this briefly in our previous quarterly update, but we believe on the cusp of this rotation into an alt season, and this is where the capital does start to shift slowly and then more aggressively out from Bitcoin and into alts. And so if we look at last quarter, our layer ones, that segment of our portfolio is really where we saw significant growth relative to the other segments of our portfolio. And some of the drivers around this were some of the ETF flows, this new trend of digital asset treasury companies, which are companies being established to buy certain assets and hold them on the balance sheet, and also the prospect of more ETFs for alts being greenlit in the US, which we think is around the corner. And then finally on this chart, just the bottom left line chart there is just showing the Merkle Tree Fund versus Ethereum and the Eureka Crypto Hedge Fund Index, which is a basket of global crypto funds dating back to 2023, and just demonstrating continued strong performance by the fund. Thank you, and I'll now hand back to Gabe.
Thanks very much, Dean. It's fair to say that we as directors and investors in the fund are pretty happy with that performance relative to Bitcoin and all other asset classes. Probably just capturing a few things Dean's commented on there is the structure of the fund. One of the reasons we're structured that way is because we are heavy investors in the fund. It is the majority of our exposure, and hence we're investing in the way that we think is best for outcomes and getting the best result from the digital asset space. Importantly, and that is staking. So sometimes we get asked, well, what about compared to an ETF? When you're generating 3 to 4% yield in the fund, you're actually outperforming an ETF, because an ETF has a fee drag. An ETF in Bitcoin doesn't have staking. So if you're paying 0.5% in an ETF, well, the fund will outperform when it's generating that 3 to 4% yield, even after fees. You're getting a positive carry. In terms of custody, the other one that I think is really important is safety. We're happy to take risk in the space, but we've got the same custody as BlackRock. That is Coinbase. You're insured by Lloyd's of London. And that risk management aspect really came through with the $20 billion sell-off. So there are strict risk management protocols in place, and that meant that the fund was in fact positive whilst other funds were blown up. So a 14.8% positive performance over a quarter where Bitcoin yielded 5.9%, I think is commendable, and well done to the team, and especially the Chief Investment Officer, who we'll now hear from. Over to you, Ryan.
Thanks, Gabe. So just a quick look at some headlines that you may or may not have seen over the last quarter and even the last few weeks as well. Morgan Stanley's Global Investment Committee has been started calling 2 to 4% allocation to crypto, not just Bitcoin, but crypto. So we thought that was really interesting that they're the next one to fall in the line to start recommending portfolio allocations there. That's a pretty big investment house in the US with 8 to 10 trillion, I think, under management, following the likes of JP Morgan and both BlackRock and others. So one after another, these seem to be falling in line and sort of recommending these pretty conservative 2 to 4% allocations. 2 to 5 to 6 is what we're generally seeing. So that's great to have another one on board. JP Morgan went a step further and actually labeled Bitcoin and gold the debasement trade. We'll talk more about that in a little bit, but they also gave a year-end price target of 165K for Bitcoin. So that's still a pretty big move left for the rest of the year, and we'll talk about why that might happen too in a moment. And another really interesting one from Deutsche Bank. Their report suggesting that they expect to see Bitcoin on central bank balance sheets by 2030. So the central banks have obviously been buying a lot of gold recently. We'll talk about that soon too. Is there room for another neutral reserve asset on their balance sheets? Deutsche seems to think so, and so do we. So that'll be really interesting to see if and when Bitcoin starts getting added to those balance sheets too. And really big recent news the last few days, we've seen the Solana ETF effectively approved. That's the 19.4Bs. We're still waiting for S1s. We believe, our understanding is the SEC needs to, the government shutdown needs to end for the SEC to be able to do some of this work. And then that's apparently the S1 filing. So hopefully they can do it on a skeleton staff. We're yet to see that, or the government opens. Either way, I think we will see those Solana ETFs approved and trading rather very soon. Which will be great for the next leg of what we hope to see is this altcoin season. A lot of capital has obviously been piling into Bitcoin through the ETFs because they're so easy for institutional investors to get access that way. Likewise for Ethereum, has had a great run the last 4 months. Solana can now join that and get some pretty serious capital flows from that new buyer. So we look forward to that, and hopefully that happens in the next few days. On the debasement trade, now JP Morgan have put that title on it. We think it's really interesting that someone like them would pile, from someone who was quite negative about Bitcoin only a few years ago, and even less than that, has now put gold and Bitcoin in the same basket and sort of defined this trade as a debasement trade. Ultimately, what's a debasement trade? It is when money supply is increasing fast. Investors look for ways to store their value. So, if central banks are printing money or governments are running large deficits. That will lead to an increase in money supply. That leads to inflation. You can call that a reduction in purchasing power for those dollars. Assets seek things like gold and real estate and now Bitcoin to preserve their purchasing power. So that's what we're seeing. Also quite interesting to note that central banks are even taking advantage of that trade themselves, which is a bit of a red flag given the fact that they're the ones who oversee and create the fiat currency, that they're moving away from fiat into gold. So I think that is something investors across the world should take note of, and see if fiat isn't good enough for a central bank and they like gold and a debasement trade, then they should definitely be thinking about it as well. Structurally, we see that need and that debasement trade continuing for some time. As you can see, the debt growth v GDP growth, debt growing faster will lead to more money creation as GDP can't keep up. So the outlook there, you can see globally, debt is growing nearly 3 times faster on a global scale, and even the US is a little bit better. But nonetheless, there's clearly room for a lot more inflation to occur on this basis, and we know that the governments are going to be running their economies hot. So we expect that debasement trade to continue. A lot of talk of where we are in the cycle. We're about 4 years from the previous cycle top. Historically, Bitcoin has run on what we think is that halving event. This time looks quite different. So we are seeing a longer cycle, and there's a few reasons for that. But what we like to do, we've got this heat index, so we look at a bunch of different indicators that sort of help us define where the top of the market is. So there's a bunch of on-chain, a bunch of sentiment and technical data that we look at, and also some macro data that we look at. And that's all included in our Bitcoin heat index. There's 30 to 50 indicators compiled into there. So we're looking for confluence in those indicators to suggest where we might be at a top or approaching a top, and we might want to start removing risk from the portfolio. You can see there at the moment, this was from last week. The on-chain data is still pretty cool, while sentiment and technical are warm, but nowhere near hot. So once those start getting up closer to 100, we'll be looking to remove risk from the portfolio, but that's still a long way off. Just to dive into one of those indicators we look at, the ISM is a great business cycle indicator, and it aligns really well with the Bitcoin cycle as well. So you can see in this chart here, the PMI in that light color, the horizontal line is 50. So anything above that means it's an expansion. Anything below that means it is contracting. When it gets to its peaks, that's usually the very end of the business cycle, and monetary tightening starts to happen around there, and that aligns really closely with the previous 3 Bitcoin tops. What we expect now with the outlook of more interest rate cuts on the cards in the US particularly, that ISM will increase and send Bitcoin higher, and we'll be looking for a top in maybe at this point, maybe 9 to 12 months, 6, 9, 12 months, certainly out ahead of us. And conditions are really good for this cycle to continue. But there will be a top out there, in the coming future, and we'll be watching for that on, ISM as one of those indicators. What we expect to happen right now is a bit of a catch-up trade for Bitcoin. This chart shows Bitcoin trailing M2 and gold by 80 days, that's 10, 11 weeks. That correlation has been really strong for the last few years, but what we've seen over the last couple of months is Bitcoin has started to lag M2 a little bit. Often the big drivers of Bitcoin are 1, M2, 2, gold, and 3 being risk on, risk off sentiment. So it's usually following one of those 3 things. Usually M2 is the most likely. Right now we've been following gold, and gold has obviously had a great run the last couple of months. We do expect Bitcoin to close the gap up to M2, and probably gold to come back. It's probably a little bit overbought here and might come back down to the M2 line. But we do expect that to happen over the next few months. even today, we've got a little hint that the gold has given back some of those gains. So when gold does do that, it gives room for Bitcoin and other assets to run as well. So this is, gold is really people looking for somewhere to store their value. And when that gets a little bit overheated, Bitcoin is the next best place to look for that. Another great indicator, you might have seen photos of people in Sydney lined up around the block to buy gold. That should tell you we're pretty close to a top as well. So that's a really nice top indicator that's worth paying attention to. We think that now give a little bit of space for Bitcoin to run. Institutional investors, hedge funds will be looking at this, seeing gold a little overpriced, probably selling their gold on the back of that top indicator, and moving into a different store of value being Bitcoin. And they can still participate in the debasement trade, but it's something that's a little more undervalued relatively. So that's sort of how we see the GPM call for 165K by year end to play out. That would be Bitcoin following pretty strongly on gold's lead higher. And then we also, as Dean was mentioning, expect alts to perform really well in that period as well. If Bitcoin is running hard, we expect alts to follow whilst monetary conditions continue to ease. We expect to see QT formally end in about a week's time at the next Fed meeting. Another rate cut and rate cuts out as far as we can see until we get a new Fed chair, and probably some aggressive rate cutting when that happens. So the outlook is really good. Bitcoin has taken a little breather here, and we expect a bit of a catch-up trade to happen pretty soon.
Thanks very much, Ryan. Just a reminder, you can ask questions at the top of your screen. So there's a Q&A button there. Please click on that and then ask your questions. I've got a couple that have been put in. Before I do, though, a quick recap on what Ryan said. So major banks, we're seeing more move into the space, which is certainly heartening. There's plenty of tailwinds behind the digital asset space. We're talking about regulation, governments buying, now more major banks moving into the space, and they're saying 2 to 4% allocation. I can tell you now, there's plenty of people in Australia that are lacking that 2 to 4% allocation. So it'll be interesting to see how that plays out. Solana ETF, that's meaningful for the fund because we have a material position in Solana. We're expecting to see some flows into Solana once the government shutdown is released and the Solana ETF goes live. The debasement trade, that's the latest tailwind behind Bitcoin. We've seen gold rally, hitting up towards all-time highs on gold. Typically, Bitcoin follows that money supply. We're seeing gold sell off today. Have a look at what's happened to the Bitcoin price today. So that's probably a good indicator of what Ryan was saying. Bitcoin following the gold price, people moving into real assets, storing value with gold at all-time highs. Perhaps they're selling off and then moving into Bitcoin. We expect Bitcoin to continue to rally. And indeed, the market at the moment is saying $165,000 US should be where we're at by the end of the year. If that was the case, if you look at our previous quarterly catch-ups, we've spoken about alt season and how alts perform in alt season, typically many multiples of Bitcoin. So if we're seeing Bitcoin at 165, then we're thinking the fund will perform very well over the next 6 months. And indeed, you would have heard Ryan say that we're looking at this current positive phase stretching out for probably 6 to 9 months, with the indicator at the moment lukewarm, and looking at a good time to invest. That's a good summary of the guys, I hope. Over to some questions. So the first question I had was back to 4-year cycles for you, Ryan. Do you think the 4-year cycle is still relevant?
Yeah, we see it less and less relevant. We would be near a top if it was playing out at the moment, and we're just nowhere near that at the moment. So to have a top, you need a parabolic run. Typically, that's what's happened in all the other previous cycles. We haven't had that yet, and that can be a sign of the market maturing as well. So there's more institutional investors coming in now. A lot of that capital comes in unleveraged, so we don't get that overbought situation. We know the monetary outlook is pretty good for more easing. And the longer that those 4-year cycles go on, or the further we go through them, the amount of Bitcoin that is reduced in terms of supply at each halving event is also diminished. So that amount of Bitcoin is less and less impactful in terms of what's being taken out of supply. So it's not surprising to see it weakening as we go.
Thanks, Ryan. Second question is around altcoins. We've had a few false starts with the altcoin season commencing. Do we think this time it's different? Well, I'll give a partial answer, then hand over to Dean. Coming from a traditional finance perspective, have a look at the gold space. What we saw first was the large caps move. Then you see it move out into, and by the large caps, we mean those that are producing gold. You then see that moving out into the mid caps. And then finally, you see the gold miners performing well. So the typical cycle is you go from large caps out to small caps. And the other space you can see that is silver. Everyone was saying, oh, this time it's different because gold's being purchased by central banks. Silver's not going to rally. Guess what? Silver rallied. I have never seen a situation where this time it's different has played out. Sometimes the timeframes for those things playing out are different, but the people make history. History seems to rhyme. Why? Because people become fearful and greedy and act accordingly. Any comments on altcoin season as you're seeing it, Dean?
Yeah, bringing it back into crypto specifically, and that concept of risk moving out the risk stack. The one thing that we're keeping our eye on, and we think will happen slightly in a different way this time around, is we do expect money to move out into riskier crypto assets, but the sheer landscape of crypto assets now there are just millions of them. So we think capital will be looking at fundamentals a little more. So those particular projects which do have stronger communities around them, stronger revenue and developer adoption metrics. So we're expecting capital to move out into the alts, but it will require investors to be a lot more selective with those assets that they do choose.
Thanks very much, Dean. With no further questions, a quick summary of the fund. Your opportunity to invest is open every month. It is priced monthly, closes monthly. So the next fund close is at the end of this month. You are in a set of smart, secure and safe hands. You're in the crypto space across a diversified portfolio of crypto assets in the top 50. Custody by Coinbase means you do have insurance by London. We're interested in getting the risk or the returns of the space, but are protecting against absolute loss. From a tax and reporting perspective, nice and easy because it's a unitised trust. Minimum investment of 50,000, and you do have to be a wholesale investor. So you'll need a certificate from your accountant or someone accredited to do so, providing a wholesale certification, and then you're able to invest. Any questions, please log on to the website, www.merkle.com.au, or reach out to any one of us. We're very happy to answer questions. The door is always open. Just here to hopefully encourage you to learn more about the space. And please have a good afternoon, and thanks again for your time.